Welcome to your virtual CFO coach. I'm your host, Leah Torbert, founder and CEO of Harrington Strategic Partners. I've spent my entire career working in the startup world, scaling businesses to multi-7 and 8 figures. I built this podcast to share all of that knowledge with you and make your path to success shorter and easier. Tune in each week as I cover topics including financial analysis, cash flow management, holistic strategy, mindset, and more. Now for today's episode. Managing your financial data doesn't have to be time-consuming or stressful. With a little bit of work up front, you can knock off hours per month of accounting tasks and trust your financials to make business decisions. Today's episode is going to be about my 6-step process to get your financials organized, get things running in the background, and save you that time and give you that peace of mind. So we're going to jump right in. Step number 1 is keep them separated. If you are mixing your business and personal transactions, you need to stop right now. Whatever else you're doing, whatever other ideas you have about how to make changes in your financials, none of that stuff matters until you take care of this one. Have you ever heard the phrase piercing the corporate veil? Owners of a business with legal entity status, so that's LLCs, LPs, S Corps, C Corps, the reason why you file a legal entity is to have limited liability protection, which means that your personal assets can't be taken from you in case there's some kind of lawsuit or other issue with your business. But that limited liability protection only works if you can show that your business activities are truly separate from your personal activities. If you're constantly mixing business and personal together, a judge could rule that there is no true separation, which means that he can't tell the difference between what is business and what is personal. And if that's the case, your personal assets could be at risk. So don't take the risk of losing everything because it's too much of a hassle to keep your business and personal expenses separated. There are rules to follow for each type of entity to take a distribution and or pay yourself a salary to cover your personal expenses. So know those rules and follow them. Immediately, if you do not have a separate business bank account and credit card accounts for the business, you need to get those set up. That's step number 1. Set up and maintain separate business bank and credit card accounts. Step number 2 here is don't pay for your personal expenses with a business account. Now, I understand every once in a while, you may grab the wrong credit card and you don't realize it, so you charge some gas on your business credit card. There are ways to deal with that, and if it is a random accident, it's not going to cause you any trouble. But if you're doing it constantly, which indicates that you don't understand the difference between the business account and the personal account, then you're going to have problems. So do your best to keep everything separate. Don't grab that business credit card because you know money's there and it's not on your personal card or the bank debit card or whatever. Take the time, transfer the money from the business account to your personal account the correct way by taking that distribution or paying yourself additional salary if you're not getting enough out of the business every month to cover those bills. So just quick recap, set up and maintain business bank and credit card accounts. Don't pay for personal expenses with a business account, and pay yourself according to the guidelines related to your entity type. If you're not sure what those guidelines are, contact your CPA or you can reach out to me and I'll help. Okay, so step number 2 in our process is to automate routine tasks. Software like QuickBooks allows you to connect most business accounts to your books to automatically import transactions for your review, which means you can set up your business checking, your business savings, your business credit card accounts. If you have loans through traditional lending institutions, you can more than likely connect those loans or lines of credit as well, so that all those transactions are coming in automatically into a screen that holds them for you, and then those transactions can be processed when you have time. To help with that processing time, you can set up rules inside the software That way, when a deposit or an expense comes in, if there's a rule, that rule can be applied to that transaction. And then all you have to do is take a quick look at it and go, yep, that looks good. So an example of that would be to set up a rule saying that all transactions coming into a specific account, or you can choose some accounts or all accounts that have the words Reliance Energy in the memo. And then you'll say this transaction will have the vendor set as Reliant Energy and the account set as utilities. And then you save that rule. And then whenever something comes in that meets those requirements, then it will become vendor Reliant Energy, account utilities. And you'll be able to see a little green notice on the screen that says rule applied. And you can take it one step further if you choose to actually have transactions that have a rule applied to automatically post to your general ledger. I don't recommend this for my clients because even though software does a great job of trying to apply the rules and reading the data that comes in, sometimes mistakes can happen. And so I'd rather spend 5 minutes just quick checking the transactions before I hit post than having to worry about it later when something comes through on the financial statement that just doesn't look right. Some other items that you may be able to automate are recording recurring credit card transactions like subscription fees. You could set up recurring bill payments. Maybe you send out monthly statements to your customers if you have accounts receivable. You can automate that process. Something else that you can do if you use e-commerce sites like Amazon or eBay is to use a connector to import the sales transactions and the payment information directly from those sites into your books. And so you don't have to manually do any of that. And depending on your business, the options are pretty wide ranging as far as what's available and what you could automate. But this gives you an idea of just ways to save time and improve your data accuracy all in one step. Okay, let's move on to step number 3. Let's talk about timing. Do you know what accounting method you're using? So there's 2 types of accounting methods. There's cash method and accrual method. If you're not sure, look at your last business tax return to see which box is checked. This will at least tell you how your CPA reported your financials. Now that doesn't mean that you're not tracking on an accrual basis, because you can track on accrual in your financial software and report on a cash basis under certain circumstances. But at least it'll give you a good idea of what's probably going on. But if you're not sure, talk to your CPA about that. Many businesses typically start out reporting on a cash basis, mainly because it's just easier to maintain, and they may choose to change to accrual, or could be forced to by the IRS if they don't meet the cash reporting requirements at a later date. So what's the difference? Cash method is like looking at your bank statement. Cash comes in, cash goes out. The transactions are recorded by your bank on the day the transaction happened, regardless of when the related products or services were delivered. The accrual method aims to match the revenue and expenses to the period that they were actually earned or used. So a good example would be your invoicing. If you're on a cash method, your revenue is recorded on the day that your customer pays for the service. If you're on accrual, then you issue an invoice to the customer, and that invoice date is when the revenue is recorded. And then later on, when you get paid, you record that payment. So if you're tracking accounts receivable or accounts payable, instead of just recording the sale when cash comes in or recording the purchase when you actually pay for it, then you're using the accrual method, at least in part. There are other aspects to the accrual method besides your accounts receivable and your accounts payable. An example would be prepaids. So say you buy 12 months worth of subscription to save 20%. On the cash method, you would just book all 12 months on whatever day you paid for it. Under accrual, you would actually break up the total cost over 12 months. And there's a process that you can set up behind the scenes to run automatically in the background to do that allocation. So if you know what method you're using, then you can be consistent in how you're posting transactions so your financials don't get messy. You're not posting one 12-month subscription in January on a cash method, and then you buy another 12-month subscription in March and you decide to break that one out. Like, you're not doing that. It's one or the other. And the other thing is, if you're thinking about switching from cash to accrual, you need to go through the process of understanding what that's going to mean for the business, how your processes will change, how that's going to impact your tax liabilities before you do that, because you can't bounce back and forth. You need to make that decision and stick with it if it's the best thing for your business, assuming that you can qualify to file your taxes under cash. And again, if you're not sure about any of that, talk to your CPA. But getting back to how you're posting things in your books, consistency is important. So knowing which method you're using will determine how you set up your processes to post your transactions consistently. The consistency saves you time, saves you money, and it gives you more confidence in your financials because you know things are getting posted the way they're supposed to be, the same time, every time. Plus, it's also going to save you money at tax time when your CPA needs to get into your books and do the review, because they're going to have less questions. They're going to see that your data looks really clean, things are getting posted consistently, and so they'll be able to do that review faster and it'll save you money. Quick bonus tip on accounting methods. Knowing your accounting method and using it to your advantage can also help reduce your tax burden, because the timing of when you record the revenue and expenses determines when the profits are considered taxable. So under the cash method, for example, you get paid, that's your revenue, that's when it's considered income. So if you do the services in January and you don't get paid until March, you don't capture any revenue until March. But under accrual, if you do the services in January, it's revenue in January. Doesn't matter how long it takes for the client to pay. And when you're inside a single calendar year or a fiscal year, if your fiscal year is different than the calendar year, it doesn't really matter. But where you can really see some changes is when you're looking at the end of your fiscal year. So say, for example, you're on a standard calendar fiscal year. So your fiscal year ends in December. And you're looking at your tax liabilities and you want to try to save some taxes now because you need to look at your cash flow. If you're on a cash basis, one of the things you can do is look at when you pay your bills in December. So assuming you have the cash flow to do so, if you're trying to reduce your tax burden for the year, you could pay bills that are due in January in December to book those expenses in December to get them into the current tax year. Or, there are some other things on the accrual side that you can do where it's, maybe you ask your vendor to not bill you until the first of the month, or you choose to not bill your customer until the first of the next month. That way that revenue or that expense goes into the next fiscal year. So there are some things that you can do there to look at your tax liabilities and your cash flow and make those business decisions if you trust your data. And that is why we're following this 6-step process. Okay, step number 4 is simplify your chart of accounts. One of the things that I don't like about software like QuickBooks is that they give you this standard chart of accounts, and it's pretty bloated because their chart of accounts needs to be applicable to a bunch of different businesses. And so it's very generic. There's a lot of different categories on there to meet that wide range customer base that QuickBooks or other software have. And so what you end up with is some pretty weird looking things that may not make sense for your business. A good example is looking at travel expenses. The typical standard chart of accounts that you get issued with a software program like QuickBooks We'll have travel expenses as a high level category, and there will be subcategories underneath it. So it'll be airfare, car rental, fuel, hotels, parking and tolls, those kinds of things. And so instead of having one travel account, you can have 5 or 6 or 10, depending on how it's set up or depending on things you may have added because you thought it would be neat to see how much you were spending in that little category. Here's the problem with that. Unless your business incurs heavy travel expenses, like maybe you have sales guys that travel all over the state or multiple states, or they travel internationally. And so monitoring specific types of travel expenses can be critical to negotiating prices with vendors. Unless you have a situation like that, it's probably not worth the time and trouble to break down your travel expenses into a bunch of these subcategories. And this can apply to other things like repairs and maintenance. I have seen repairs and maintenance where there's subcategories for like every type of thing that the business may have, like office equipment repairs and maintenance, and landscaping repairs and maintenance, and signage repairs and maintenance, and any number of other things that you can think of. But it's probably not a critical thing to be monitoring in your business unless that's directly related to something that you're pushing a lot of cash through and will have a deep financial impact for you. So take a look at things like that in your chart of accounts and look at how you can simplify that structure. The more complicated your chart of accounts is, the more time it will take to code transactions, and the more likely it is that something will get coded wrong, ruining the entire point of having a subcategory to begin with. So keep it simple. Don't create a bunch of different accounts to track revenue expenses in unless there is a true business case to see the data in that manner. And also remember that there are other ways to break your data down and to review your data besides looking at your P&L and your balance sheet. Accounting software comes with a lot of standard reports where you can see your breakdowns based off of customers, based off of vendors, based off of products. So you can get a different view of what's going on in your business without cluttering up your P&L. And if your business has this need, you can also implement things like class tracking or location tracking, which can give you another dimension of your data, but in a separate report so that you can see the high level on your balance sheet and your P&L, and then you can dive deeper when you want to look at how these expenses or how this revenue is being divided up among the various things in your business. Okay, let's move on to step number 5. This is a big one for me, maintaining your documentation. There are so many apps out there now that capture pictures of receipts and invoices and other kind of financial data that there's really no excuse to not have them. Most companies today give you the option to receive communications electronically, so you have the data in your inbox right away. A lot of places I go to now don't even print paper receipts. They want your email or they'll text it to you. So you already have it digitally. So there's no excuse to not know where your paperwork is and be able to provide backup for an expense or revenue in your business. This doesn't mean that you're supposed to be the one necessarily to organize all the receipts and all the invoices and payment plans and contracts and all that kind of stuff. Unless you're a very, very small business, you're probably not the one that should be doing that. But you can create a workflow to send all of this documentation that may be coming to you directly to a shared inbox or a server folder where someone else can sort and store that information. It could be your assistant, could be your bookkeeper, maybe you've got somebody on the operations side, whatever the case may be, someone else can do that sorting and organizing for you. But the important thing is that you have the backup documentation available for the transactions that are in your accounting software. Remember that corporate veil I mentioned in step 1? This is another way to make sure that you're protected and maintain your limited liability status. Because if something is ever in question about what you spent your money on, then you can produce the receipt, produce the invoice that says, yes, this was for a legitimate business expense. And you've proven the case, and there's no question that that money was spent appropriately. Okay, final step. Step number 6, make your tax payments. Setting aside money throughout the year for your taxes and making your estimated tax payments is critical. Estimated tax payments are due as follows. For the period January 1st to March 31st, due on April 15th. For the period April 1st to May 31st, due on June 15th. From the period June 1st to August 31st, due on September 15th. For the period from September 1st to December 31st, they're due on January 15th of the following year. While you do not have to make a payment every quarter, you do need to have paid in enough taxes by January 15th to avoid the underpayment penalties. There is something called the safe harbor rule. And so the safe harbor rule sets forth requirements based off of your particular tax situation on how much you need to have paid in by January 15th to avoid underpayment penalty, regardless of how much you ultimately owe. Like I said, it is dependent on your particular tax situation. So please reach out to your CPA to discuss the safe harbor rules and to make sure that your estimated tax payments are calculated correctly for your tax situation. And I'm going to have a link down in the show notes to the IRS webpage for estimated taxes. And one note that I want to make here, depending on how your business is set up, you may just have the LLC. Maybe you have a corporate structure where you have an LLC that is owned by your LP and then you own the LP. Or maybe you have an S Corp that owns your LLC, or, there are lots of different options there. But ultimately, someone has to pay that tax, regardless of where the money is coming from or how it's being allocated to yourself, your partners, or maybe other entities that you own. Someone has to pay the tax. And so ultimately, these estimated tax payments need to be calculated. Money needs to move appropriately to pay for those tax payments. And so talk to your CPA about how you should be calculating those estimated tax payments and where the money should be pulled from to pay for those tax payments, to make sure that, again, you're meeting those requirements of keeping business expenses separate from personal expenses. So I'm going to go back over these 6 steps really quick. Step number 1, keep your business and personal transactions separate. Don't mix. You don't want to pierce the corporate veil because you didn't take the time to set things up correctly. Step number 2, automate routine tasks. There are a lot of things that happen all the time the same way, every day, every month, every quarter, every year in your business. Use the ability that you have in the software, connect various things together so that it runs in the background for you and saves you time. Step number 3, understand the timing of your financial transactions. Are you on cash method or accrual? Because how you're posting those transactions can impact the consistency and trustworthiness of your data, as well as the amount of taxes that you owe at the end of the year. Step number 4, simplify your chart of accounts. If it doesn't make sense for your business to put dollars in that bucket, get rid of it. You don't need to have extra subcategory accounts just because your software set them up for you automatically and so you just assumed you needed them. If it doesn't make sense, don't do it. Keep a simple chart of accounts. Make sure that you have the ability to see the data that you need to see at the level that you need to see it and nothing else. Keep it simple. Step number 5, make sure you know where all your paperwork is. Set up workflows so that all your digital receipts, invoices, contracts, payment confirmations, all of those things get to a central inbox or a central folder on a server where someone on your team can get them organized. That way, if you need them for backup, you have them. And then step number 6, figure out how much you owe in taxes, get those estimated tax payments scheduled, and make sure that you pay in enough every year to avoid the underpayment penalties, because nobody wants to give the IRS any more money than they need to. Implementing these 6 steps in your business will greatly reduce the amount of time it takes to prepare your monthly financials and allow you to have more confidence in your financial data. If this seems like a lot of work and you don't have the bandwidth or team to support you, let's chat. If you're using QuickBooks Online to manage your financials, Harrington can help. I'm going to have a link down in the show notes to schedule a quick assessment call to determine whether we're a good fit for each other and ways that we'll be able to move forward to help you achieve your goals. Thanks for listening to today's podcast. If you enjoyed what you heard today, please share with your network and leave a review so our podcast can have a greater impact. If you have any comments or additional topics you'd like discussed on the show, let me know. Before you go, connect with me on LinkedIn and let's keep the conversation going.